Hi, welcome to our channel. Now we are starting a new series regarding trade disciplines. We have seen a few charts or the few previous videos where we analyzed the prices using Elliott waves and we had tried to come up with some view regarding where the price is expected to move. Now all the analysis is on one side. The other part is basically how you trade and how you ensure that you make money. Now, there are disciplines that say that if you want to make money, you should give the minimum money to the market. Now, for that particular reason, you should have a very good discipline. And one of the thing that it starts with is your trade journal. Now, what is a trade journal? So, chart aside, we'll come to Excel today, and there are so many things that we can do or note down, monitor for the trades or the analysis that we do. The simple funda of a trade journal is first you record what your analysis is, you record what is your position going to be, as in where you enter, where you exit, and what should be your stop loss. And basis the different recommendations or the analysis that you do. Say if you do analyze say 20 charts in a day, and out of 20 you get 3 or 4 good positions. Out of those 4, which one you can go for? To decide that, there could be some kind of a weighted system or a metric system. Now, there are certain things that I follow in my trade journal, and we'll see this in a stepwise manner. And this is what we are looking in this video: a trade journal, a sample template, and something that helps us making those decisions. So let's get into it. Now, the first part here on the left side is what something I called as RID. It is like a research ID. That means that whenever I do analyze a chart, it gets a number in the sequence. So this is something that I've analyzed in the last couple of months, or I think that this starts with, I think, February or so. So a lot of analysis, and every analysis has a research ID, which is what my trade is based on. So the next part, when I'll cover the journal, the trading P&L or the transactions that we do, there I have a reference of this RID, which helps me which makes it easier for me to track what was the basic analysis when I decided to basically enter into a trade like this. This is the date on which this is analyzed. This is the week, again simple. This is the name of the commodity, stock, whatever. This one is source. Now, what do I mean by source? Source is something, it could be a screener, it could be something from where you got to know, or where something that got you interested in the particular script. Okay, so I have certain screeners which I use. I have certain queries. There are certain people always recommend something. So there is this column called rec. It means that somebody has told me about this talk, and because of that I've seen it. There is revisit, that something, it means that I had analyzed it some time back, and I said okay, I need to visit it again after 2 weeks. So when I visit again after 2 weeks, I call it revisit. So it depends how you want to name it, how you want to call it. The idea is basically that you need to know the source, why you analyze that stock in the first place. This helps you with two things. First, if you are running a screener, it will tell you if your screener is working or not, firstly. Second, if you are revisiting a stock, you will have a check that you said you wanted to revisit this after 2 weeks, and you actually revisited. So this revisit is like a check done, that after a certain period you uh, sort of checked it again. This is the comment, and this is the overall view. Like, what is the view which is making me decide, or which is making me believe that it should be a trade or I should just exclude it. So trade or wait is my way of saying ignore trade or wait. Wait as in time is not right, things are not in place, probably we should revisit or whatever. When I say trade, it means a single signal for me that it is something I can consider a trade for. Now I'll also come and see, I'll show you a couple of examples later. So this is the basic information. Now the things that I'm very particular about is about the exit entry and the stop loss. So buy and sell is basically, I can have a short position, I can have a long position. Depending upon that, it calculates the risk reward and stuff. So There is some complex formulas and stuff, but it's simple logic. We'll see one by one. Now, this means that my this particular position, okay, let's get into the actual trades that we want to see. So I've identified a couple of trades to discuss for this particular video, something that I'd analyzed sometime back. So let's see it. Now, I'm not saying, I'm not getting into whether this analysis is correct or not. Probably it could be very off, it could be very wrong. This is not the idea, or this is not the objective of this particular video, but I'm saying if I have a couple of views, what is something that will make me decide which trade to go after. So let's see one example, say Reliance Industries. Now, I've already marked certain things on my chart. Now, I'm not getting into what discounts are and what I mean by all this, why I'm saying this is the count, etc. Let's, for the argument's sake, consider that this is what it looks like and this is how I want to trade it. So what I'm saying is the price is currently at 1245-ish, and I'm expecting it to go till 1376 in say by say January 25. This is something what I've tried and noted it down. I want to buy it at 1245. I will sell it at 1376. My stop loss is going to be 1241. Now, unless I have these three values, it will not be a trade. I mean, that's the basic discipline that I'd like to follow, and I try to follow it. So unless I have a clear entry, clear exit, and a clear stop loss, I will not even consider trading it. Now, basis this, it is calculating risk and reward. So I'm saying I am expected to get about uh, how many 1030 odd points, and my stop loss is very close. Stop loss is only 4 points away. Now there are two things with it. One is stop loss is near, so it's a good risk reward. But it also means that because my stop loss is near, the chances of it hitting is very high. So I may decide to have a stop loss which is that close if I'm looking for a good risk reward sort of thing, but it also comes with a downside that my stop loss can be hit very easily. Now this is my lot size. By lot size I mean that I want to buy 20 stocks of Reliance at this particular price, which will be a trade value of about 24,900. And in this whole trade, I may have an upside of 11%, which I'm expecting it to reach in 65 days. Say, come to the chart again. This is where I'm expecting the price to reach here. Let's assume it is all true. I'm not saying it is, or it's just a view. I mean, if you want to analyze it, you can analyze it yourself. But the point of discussion today is about journaling. So let's assume that this is all true. I mean, the expectation is this. So in 65 days, we are expecting it to reach 11% upside. Now, when I do an annual return, it is 58%, and I'm expecting it to reach the price on 25th January 2025, which is an absolute increase of 2620. It's just simple multiplication of lot size into sell price minus lot size into buy. This is what I'm going to get. Now, with the risk that I have a stop loss 4 units below, with that particular risk, I may, if my stop loss is hit, I will give market 80 rupees in this particular trade. And my stop loss, or the money that I'm going to lose if this stop loss is hit, is 3% of the total profit that I may get if the trade goes right. Okay, established. This is what this entire analysis says. Analysis says that I have a buy price of this, sell price of this, stop loss I'm putting at this, which means the risk reward is 32, which means that I may earn 2620 if my trade is right and if my target is hit. And if my stop loss is hit, I'm expected to give 80 rupees to market, which is just 3% of what I'm expected to earn. This is one case. Now the second case we'll see of Platinum Industries. Again, it's the debate is not regarding this whether this analysis is right or wrong. It could be right, it could be wrong, but I'm saying whatever the analysis is, how I'm noting it down. Okay, so here I'm expecting that this is wave 1, wave 2 complete, and it may lead to wave 3. So I'm actually hoping that the target is going to reach at about 798 in April last week somewhere. Okay, so this is the situation. I'm expecting it to go from 420 to 789 in say 6 months or so. So let's come back to the journal. In journal now again, I have a view. I'm saying that okay, it could be making two, it can be traded for wave three. Now I'm entering at four. I'm expecting to enter at 425. I'm expecting it to sell at 789, and I have a stop loss at 353. Now here the stop loss is slightly bigger. I have a stop loss which is slightly farther down, and this is what the impact is going to be of this. Now in this also my risk reward is 5, roughly 5 times I'll get the reward if I mean the risk to reward is 5, reward to risk I should say. Now here also I'm expecting the lot, I'm considering a lot size of 50 with a price 425, which will be an approximate trade value of 21,250, which is an upside of 86% if the view is right. Okay, and this is something I'm expecting in 185 days by April 20. Oh, 155 days. It was April 25. Okay. In 155 days, I'm expecting an upside of 86%, which is annual returns of 199%. And if the trade is right with the amount that I've invested here, I may get 18,200. Okay. But if my trade, if the direction goes wrong and if my stop loss is hit, I'm expected to lose 3,600 in this entire trade, which is a riskier trade, which is about 20% of the absolute profit that I may get. So we have two scenarios here now. One is saying that I have a risk potential of only 3% and I may get 2600 here. I have a risk potential of 20% in the second case, but I can get about 199% of annual returns. So this is the two set of things that I have for today. Just assume that I have only found I have just done two charts and I found two trades in it, and these are the trades that it looks like. Now, if the view is regarding now where this slope thing comes in. Now, when I have multiple such trades possibilities, as in it really makes sense to choose the best one for you and put your money into say a fewer charts or a fewer stocks than to actually diversifying it. Than if you say if you analyze 10 and if you got 5 trades, putting your money into 5 trades will not give you great returns. So generally it is again after this particular trades that you find, second level of screening is required. And these numbers that we get here by putting simple formulas help me decide which one to go for. Now, I feel the second one is more lucrative because I have an absolute upside of 86% I can get in about 155 days, which is a good return because the ARR is fine. The annual return is very good. But if I am looking for a short time trade, now this could be if I had say just for argument's sake, if I was expecting this in 15 days, my ARR would have been very good. Now in this case, this could have been a clear winner. That okay, I'm expecting 11% in 15 days, ARR 253%, risk is very low, absolute profit is decent, go for it. But now because I have a trade which I'm expecting not so great returns compared to the second one, I'm slightly tilted to go towards the second trade that I'm hoping. Now the potential downside is that I have a bigger risk. I may lose a bigger capital if my trade goes wrong, if my stop loss gets hit. But when you are trading with a journal, you are actually signing up for the risk that you carry, or you are aware of what is the possibility or what you are going to lose if the trade goes wrong, and you have a clear picture. Now there could be different ways you can utilize this information or you can process this information. If the view is that no matter what, I should not be uh, I should not be making say 10,000 rupees loss in a month, I will be very picky and choosy about it. because that's what the objective was, right? This was the thing that we were trying to optimize. The loss should be minimum. I'm not expecting really to always maximize the profit. So it again, it depends. There could be different school of thought which says that okay, I have a higher reward here. I'll take a higher risk and I'll trade it, whichever suits you. But this gives you pointers to decide on. Firstly, you should have n number of charts analyzed. You should have say at least 4 5 trades for the given point in time when you are actually making a decision. Out of those 4 5 trades, which one is the best one you will go for, or what combination of money you will allocate, is something you can get from this kind of uh, analysis or this kind of data entry. Now, this is slightly manual work, but this is something that puts you in a better position. Now, I'll tell you sort of just to give a number. I'll take one day where I'd analyze certain number of charts. So I've probably analyzed 39 trades on this particular day, and I've gotten only how many? Oh, quite a good number. So 14 trades out of 39 charts analyzed is a decent combination. Now, if you have more such numbers every day, as in if you find more trades in a particular analysis setting that you do, maybe you do it on a weekly basis, or you get set on your charts on every night or whenever you get time, it is a good position. Now it is a good position to be in because I have multiple things to compare, multiple things to choose from. Okay, now here if I see slopes, this is something I'll not go for, or this is a very risky trade. I have a 92% risk percentage, as in I'm expected to lose 774 against the possible profit of 842. It's a very risky trade. I'll stay away from something like this. This is a very good trade on paper. If my analysis is right, something like this will give a very good return. Now, see the difference here. This is a very long-term trade. This is something I'm expecting to get, I mean, to hit my target in 485 days, which is just giving me, even though it is a good, decent absolute return, the ARR is 130%. Whether I want to take it or I don't want to take it, it's a discussion to have. It's a decision to basically make. Now, here in the last column, I also have a recheck date where I'm saying I've analyzed this on 15th, but I'll also recheck it on 18th. So maybe this number was not good enough for me to even actually go ahead and trade it. I probably put a comment saying, okay, you check it again on this particular day, whichever this could be. It is just all 4 days, 2 days coincidentally. But there could be stocks where I say, okay, I should check this after 2 months, something like that. So you can put a recheck date. And that's where the revisit comment comes from. When I'm saying revisit, meaning I've decided to recheck it on this day, and that's why I'm revisiting the stock again. Okay. Moving ahead, now here these trades are also very risky. I have a 79% risk potential. I have a 50% risk potential. I'll avoid certain trades. What is a very good kind of a trade? Again, it depends, but say something which has a risk potential of 13%, I'm quite comfortable with, provided I have a decent ARR and a decent absolute percentage, absolute return as well. So all these three combinations, actually the absolute returns and the risk reward, the risk percentage that I carry, are the main deciding factors for me. But there could be different angles to it. Now here, if you say the ARR is very good, the annual returns is very good, 500%. Risk reward is also, I mean, risk potential is, or risk percentage is also pretty okay, 13%. So I'm subscribing to lose 425 rupees in search of 3275 rupees profit. Good enough number for me, and I can decide. So these numbers will put a perspective, and it will help making that decision whether you want to trade, whether you want to leave it. Now, because I had say 10, 14 kind of options, I could choose the best ones. Maybe the best ones for me could be this, and okay, I'll color it. Maybe this, and maybe this one, 13%. Okay, so putting certain variables, putting certain decision making numbers can help you get the best of the trades that you found, and the best of the best of the best. If you actually sort and allocate the capital to only the best ones, the probability of you giving money to the market reduces, and that's where you end up making some money. So that was about it. I think this one I missed. This one is a very good trade, but it has a other side, as in it has a flip side to it, that my stop loss could be hit very easily. And if and one more thing of is a part of discipline. No matter what, if the stop loss is hit, exit. If you know, it could help us in firstly controlling our emotions. Secondly, it can help us making our analysis better. Now, there could be only one way of getting, or two ways of getting out of a trade. First, either you book your profit or you reach your target. Second, you book your stop loss, or second, you hit your stop loss and you exit. Now, there is a one more case in between, that you are halfway down there, or there is something that you are expecting it to reach in 30 days, but it's still 60 days, it hasn't reached, whatever such cases. But when you stick to exiting only when the target is hit or the stop loss is hit, that pushes you to make your analysis better. Now, if this particular stop loss is hit and I'm out of the trade, and then suddenly it starts moving in the direction which I was expecting it to, I will be forced to basically analyze it better, come up with a very more accurate kind of analysis, or maybe work for a window which is slightly bigger. So that's where 10%, 13% is a good number to have, because I have certain margin for it to dip a little and then come back and start rising. 2% becomes very narrow. So again, this is the call you can take, or there are n number of things that you can derive. You can derive all the things you want to see in your analysis. Just put it into your template kind of a thing, put some formulas, put some pointers, and you can make a very well informed decision, a very good picking decisions out of all these things when you put it all together. So that was about it. We will come back with more on this series. There is some, we have just started this. This is one part, first part of it, where you are actually uh, trying and analyzing and putting it in perspective, noting it down, what the trade, what the analysis looks like, and what you want to do with it. And later on, when you decide to trade certain things, how do you enter it into your, or how do you make your P&L? After you make your P&L, what should be the metrics that you should follow? And these metrics, how can they help you plan better in terms of your trading? What should be your trade forecast, and what should be your numbers that could look like? All of this will come to in the next subsequent parts of the video. So thank you so much. This is something different we are trying to give, other than only the chart analysis. Hope you like it. Do let us know in the comment section how do you find it, and if you like our content, please do subscribe. Thank you so much.